Trading volume is a measure of how much a given financial asset has traded in a period of time, meaning the total quantity of shares or contracts traded for a specific security. Appears in nearly every market that you'll find. That because trading volume is considered a critical indicator and are widely used among traders. For stocks, volume is measured in the numbers of shares transacted between buyers and sellers during the transaction. For futures and options, volume is based on how many contracts have changed hands. Traders look to volume to determine liquidity and combine changes in volume with technical indicators to make trading decisions. The greatest volume comes in the market opening time or at the key events. Volume can indicate market strength, as rising markets on increasing volume are typically viewed as strong and healthy. When securities are more actively traded, their trade volume is high, and when securities are less actively traded, their volume is low. Each market exchange tracks its trading volume and provides volume data. Volume overall tends to be higher near the market's opening and closing times, and on Mondays and Fridays. It tends to be lower at lunchtime and before holidays. Trade volume is one of the simplest technical factors analyzed by traders when considering market trades. The trade volume during a large price increase or decrease is often important for traders, as high volume with price changes can indicate specific trading direction or pattern within. Trading volume is more useful with the stock market, but it also can be very helpful for any market. Therefore, you must know the main volume patterns in order to know any kinds of signals or confirmations. Remember, indicator must be useful, otherwise it's just waste of space. There are 4 basic volume patterns that trader must know as an indication of further price movements. High volume trading on climbing days. This is a bullish indication that the price will continue to rise. Low volume trading on falling days. This is also bullish indication, since it indicates that on days when price falls back a bit, not many people are involved in trading. Therefore, such falling days occurring in an overall bull market are commonly interpreted as temporary retracements or correlations rather than an indication of future significant price movement. High volume trading on falling days. This is considered a bearish indicator for a market, as it shows that major institutional traders are aggressively selling. Low volume trading on climbing days. This is another bearish indicator, although not as strong as the high volume trading on falling days. The low volume tends to peg the trading action on such days as less significant and usually evidence of just short-term counter-trend retracement upward in an overall long-term bearish trend. Let's get to the chart. It is DAX 40 futures market at the daily time frame. Let's insert volume indicator on the chart. And here it is a signal from the very beginning at the chart. As you can see, at this period, while market climbs, volume decreases. And it is bearish signal that trend might change. And it really happened. As the market starts falling, volume stabilizes on around the same level. So market either will move sideways or will continue to fall, especially if we receive higher volume at falling days. Let's switch to hourly time frame now. As you can see, there are waves of volume. It's because of market cycle. Opening time, trading day, volume stays higher, and at night movement, volume stays at low. Despite that, we still can notice certain things here. As the market falling, volume stays at high level. What we can see here, when market starts to climbing, even crosses previous high, however, volume decreases. That indicating weak bullish power. At the peak of movement, volume increases, and market drops quite heavily. Volume stays at high level. At the moment, there is no any bullish signal from the volume. Let's switch to 5 minutes time frame now. The same cycles of the volume, just more accurate. At lower time frames you can and you will see the same volume patterns, which will help you to identify or confirm market movements. Volume must be used with any strategy, even with basic chart patterns, as you remember, Almost in each of them, volume is useful and let you to confirm if the pattern is really there. It might be tough to notice something at the volume indicator at the beginning, but as the time passes, you will find it more and more useful. And it will tell you the story behind. Moving averages. The moving average is a simple technical analysis tool that smooths out the price data by creating a constantly updated average price. The average is taken over a specific period of time, like 10 days, 20 days, 50 days, or any other time period that trader chooses. There are advantages to using a moving averages in your trading, as well as options on what type of moving averages to use. Moving average strategies are also popular and can be tailored to any time frame, suiting both long-term investors and short-term traders. All moving averages are lagging indicators, which means they are usually late and more useful at bigger time frame, such as daily or at the most hourly. These indicators usually confirm market trends once they have been formed. They do not predict future price movements, so you have to use it carefully. The 200-day moving average is considered by the most analysts as critical indicator on the chart. Traders who are bullish on the market want to see the stock price remains above the 200-day moving average. Bearish traders who are selling want to see the market price stays below the 200-day moving average. If the price crosses from below the 200-day moving average to above it, this is usually interpreted as a bullish market reversal. A downside cross of price from above the 200-day moving average is interpreted as a bearish indication for the market. The interplay between the 50-day and 200-day moving average is also considered as a strong indication of future price movements. When the 50-day moving average crosses from below to above the 200-day moving average, this event is referred by the technical analysts as a golden cross. A golden cross is basically an indication that the market is gold set for substantially higher prices. On the flip side, if the 50-day moving average crosses from above to below the 200-day moving average, this is referred by the analysts as a death cross. You can probably figure it out by your own what a death cross isn't considered to bode well for a market's future price movements. Let's get to the chart. On your screen, it is Nasdaq's 100 futures market at the daily time frame. Let's insert moving average indicator at trading screen. You can find many moving averages. Choose the simple one. Any other are not so relative. Also, choose 200 periods and insert him. Let's just move to the left for a bit. As you can see, the market had a long bull run. Moving average stayed below the price until this area. Price passes through below, tests it once, twice, and bear trend moves downwards until again passes through above this time, tests it again, and the bull trend starts, which one continues until now. It is really strong confirmation of the trend. Now insert another one moving average with period number 50. Choose appropriate color of the line and insert. Let's move back to the same area. There it is. Death cross, which afterwards market fall into long bear run and appears golden cross, which afterwards market turned bullish until now. So it is a really powerful indication. 50 moving average also indicates shorter trends or potential bigger trend reversals. Also shows market indecisiveness when price starts to dance below and above, as you can see for example right here. Also this one produces more false signals, so you have to be careful and never take a single signal based on him. That would be it about moving averages. Useful to confirm trend once it has started, or temporary retracements, and sometimes even to determine market indecisiveness. Do not use it in your trading chart. There will be a lot of false signals for sure. Only to daily time frame, or at the most hourly. There are many other indicators. Among most popular ones are Bollinger Bands, Fibonacci, RSI, MACD, stochastic, but those produces too much false signals, and to use them for long-run trading equals to impossible. Of course, sometimes you can make money even from those. Sometimes they work, but it is not recommended even to start using them. Everything you see or touch as trading must be used in proper and systematic way. Gather statistics, and based on your statistics, adjust to your benefit. Otherwise, it is not even worth to start using that tool. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you'd like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.